Ever wonder why some days you feel great about your money and other days it just stresses you out? It's not just about numbers. Your emotions play a huge role in how you handle your finances. Let's dive into how our feelings can either help or hurt our money decisions. Imagine Jody, a former investment broker from the last 90s. Back then, everyone wanted to buy internet stocks. She sold them to retirees, even putting all their savings into these risky investments, sometimes taking huge commissions. She knew deep down it wasn't right, but her job depended on it. When the dot-com bubble burst, many of our clients lost most of their retirement savings. Jody carried that guilt and regret for years. She had nightmares, cried watching happy retirees on TV, and stopped investing her own money altogether. This shows us a powerful truth. Unprocessed emotions like guilt and regret can linger and impact our decisions. Even years later, Jody's feelings clouded her judgment and made her avoid the stock market completely. We often think emotions are messy and bad for making decisions, but research shows they are central to both good and bad choices. Sometimes a gut feeling can lead to great decisions, especially if you have experience. However, when emotions get too strong, they can overwhelm our good sense. These feelings can be short-term, like a quick burst of anger, or long-term, like a persistent mood, and they change how our brains process information. Our emotions influence how we view money risks. Positive emotions like happiness make us feel confident and optimistic. We tend to simplify decisions, use shortcuts, and are quicker to choose. If the stakes are low, happy people might take more risks to get a gain. But if the stakes are high, they become risk averse to protect their good mood. They want to avoid big losses. On the flip side, negative emotions like fear and sadness make us more careful, even hyper alert. We focus on details, see more risk, and often overreact to losses. Regret is a huge factor in investing. It's that uncomfortable feeling when something goes wrong. To avoid regret, many investors make a common mistake. They hold on to losing stocks for too long, hoping they will bounce back and prove their initial decision wasn't wrong. This is called the disposition effect. And they sell winning stocks too soon, fearing the gains will disappear and they will regret not cashing out. So whether a stock is up or down, regret often drives biased decisions. Interestingly, research shows we feel more satisfaction when we make our own winning investment decisions. But if we lose money, we feel more regret if we made the decision ourselves. This might explain why many people hire financial advisors. They act as emotional shock absorbers, taking some of the emotional weight off our shoulders. Different negative emotions affect us in unique ways. Take sadness. It can make us want to change our situation, sometimes leading to impulsive actions like overspending or taking on too much risk in investments. Think of retail therapy. It's a real thing. Disgust, on the other hand, makes us want to get rid of things. Disgusted people tend to value items less, whether they own them or not. And then there's fear and anger. Fearful investors tend to overestimate danger and sell out during market declines because they feel out of control. Angry investors, however, often feel more in control. They might hold on to declining stocks because they are certain of their position, even if it's illogical. We also have a projection bias. This means we often assume our future emotional state will be the same as our current one. If you're feeling flush with cash today, you might think you will always feel that way and neglect saving for retirement. We underestimate our ability to adapt to future challenges. This bias can also make us overestimate the importance of big attention-grabbing events while ignoring slower, more profound changes happening in the world. Trying to control our suppressed emotions usually backfires. Instead, we need to manage them. Understanding why you are feeling a certain way can reduce its impact on your decisions. It's helpful to be self-aware. If you know you tend to get anxious during market drops, you can set up a plan in advance, like telling your financial advisor, don't let me sell if the market drops X%. This foresight can protect you from emotional snap decisions. Our emotions are powerful, shaping everything from quick gut feelings to long-term investment strategies. While low-level emotions can help us simplify complex information, strong emotions can really lead us astray. By understanding how regret, sadness, anger, fear, and even happiness influence our financial choices, we can become smarter, more disciplined investors. What steps will you take to better manage your money emotions?